Hi, I'm Jennifer Siegel from Derivative Logic, and welcome to another edition of What I Learned This Month with our in-house economist, John Rothfield. As many of you already know, John has had a long career as an economist and financial market strategist for Bank of America, and then he subsequently took up the role of Chief Economist and Portfolio Manager at CalPERS, Public Pension Fund for the state of California. So we're lucky to have him with us today. John, I want to start by asking you about our new Fed chair. Kevin Warsh revealed very little during his press conference following the first FOMC meeting that he did as the Fed chair. And now that the minutes have been released, what do you think we learned about how the committee is thinking?
Yeah, that's right. They're very hot off the press, and he definitely was in a deflective mood in his press conference where he referred to the 5 task force that they're setting up and referred to the wording in the statement rather than expressing a view. He didn't have a dot, of course, in the dot plot, so there's 18 dots now, not 19. Just a quick thing on the minutes. The minutes have only been released publicly since 1993 under Greenspan. And confusingly, they weren't released until after the following meeting. It was only in 2004, just before the end of Greenspan's long term, that they moved to a quicker release of the minutes. They felt that that communication was valuable. So given that the statement itself was quite short this time around, there was some suggestion that maybe the minutes would be short as well. And the minutes were only 14 pages. But that's really only a little bit shorter than it typically is. And there wasn't too much revealed from the minutes, I don't think, relative to what was in the statement. There was one remark which I thought was interesting, which is real private domestic final purchases, which is domestic demand in the economy, picked up in the second quarter and was rising faster than GDP, which means basically that demand is so strong in the economy that it's sucking in more imports, and it is causing businesses to draw down inventory. So it was quite a strong view on and confidence in the state of the economy right now. But one really interesting thing that stood out to me, and maybe the market hasn't picked up on this, is that remember the dot plot had 9 people expecting a rate hike this year and only 1 expecting a rate cut. That may have been Michelle Bowman, for example, who's more on the dovish side. But the minutes said that several participants said they did not see the current policy stance as restrictive, while a few others commented they saw it as slightly restrictive. And that fed into a two-way view on the next move. Even though a balance of respondents even wanted to hike in June, a small number, there seem to be several participants on both sides of the argument. There are conditions under which the Fed could ease later on this year. That was a little bit surprising because the dot plot was quite firm in terms of the next move is likely to be a hike. So a little bit of information from the minutes. And again, I think that two-way risk to rates was the thing that I picked up on.
And, you know, I guess going back prior to the actual minutes in the decision, they said that, quote, economic activity is expanding at a solid pace despite elevated uncertainty. Productivity growth and capital investment are strong, end quote. Do you think that that is a fair assessment, or how do you see that holding up?
I think that is a fair assessment. You know, you look at the first 5 quarters of the Trump administration, it's always good to do a look back to see if there's any continuity in economic activity. Essentially, in the first 5 quarters of the Trump administration, which has been quite disruptive in terms of tariffs, which are a regressive tax hike. You look at the immigration policy and you look at the downsizing of the federal government. So the economy in that first 5 quarters grew at 2%, which is half a point below the average growth in the economy from, say, 2014 to 2024. So basically, we've lost half a point of growth due to these disruptive policies. The Hutchins Center within the Brookings Institute confirms that basically government policy has taken half a point off growth. The important thing about that, though, is that those headwinds on growth become tailwinds going forward. So that half-point drag from government policy is arguably going to be neutral going forward. And that's what we're seeing in the data for the second quarter and potentially at the start of the third quarter, is the economy, domestic demand in the economy growing at 2.5% or more. The GDP now, which is the latest nowcast for second quarter GDP, has about 3% for domestic demand. So domestic demand in the economy is growing pretty quickly. The high base as we go through the quarter means that the third quarter should probably be strong as well. So I have no problem with that idea. Productivity growth is strong, although we've recently had a pickup in hours worked, which could curtail productivity a little bit. Capital investment strong. Of course, if you're in the housing industry or other forms of non-residential construction other than data centers, it doesn't seem that way. But overall, business investment is strong. And so I think it is a fair assessment by the Fed that we're in a strong growth economy. And Kevin Moore said himself that it doesn't look as though monetary policy is restrictive if you look at the economy outside of housing. And I do think that, again, with some of these headwinds becoming tailwinds, there is every reason to expect that as the year goes on, unless we have a meltdown in the financial markets, that growth in the economy will continue.
Especially since Warsh is new, a lot of emphasis is put on everything that he's saying. And he, during his last appearance at the ECB forum in Portugal, he appeared to strike a little bit more of a dovish tone, where he said inflation risks were receding. But just weeks ago, he had said that warning us about the consequences of allowing inflation to run above target for so long, for 5 years prior. And do you think this is a genuine assessment of the inflation outlook, or is this more of a communication shift, or maybe even evidence of some political pressure?
I don't think he's done himself or anybody on the Open Market Committee a favor by saying we're going to get inflation down to 2%. It's been above it for 5 years. A lot of the indicators are well above 2% right now. And then 2 weeks later, when there's a truce in the war, saying that inflation risk have receded. It doesn't work that way for 2 weeks to have such a short-term view about inflation. And we've seen, of course, today with a renewal of the conflict, that oil prices have gone north again a little bit. And anyway, inflation right now is not about energy. So there are a couple of things that make a dovish case for inflation that I just wanted to mention. One that's very interesting is that in two categories of PCE inflation, the government in September, through the Bureau of Economic Analysis, is going to downgrade inflation in two key categories. One is computer software and accessories, which has basically been growing gangbusters over the last 6 months. It's typically a deflation, and now it's a big inflation. And also portfolio management and investment advice, which is growing at about a 15% yearly rate right now. So the government does these annual revisions, and they upgrade or change their methodology for reporting inflation. And they've decided to take these two down. Now, one of the big investment banks says that's going to take 2/10 off inflation by the end of the year. And some people are going to be a little bit suspicious about that, these redefinitions of inflation are going to take numbers off. And part of that is a hedonic adjustment. Is the government making enough of the fact that, is the data giving enough of the fact that we have AI now, and that's not fully priced into the hedonic adjustment to prices, for example. So there is potentially some argument that these categories are growing more quickly than they actually are. But to try and redefine inflation down isn't going to be very helpful. It's moving the goalposts. And remember that bond yields are based on the consumer price index. This redefinition of inflation for the personal consumption expenditure deflator is going to be not into the CPI. The CPI is used for bonds through break-evens, tips, etc. So there could be a difference between the government's definition of inflation and what the bond market looks at. There are a couple of other things that the San Francisco Fed just came out with something called a inflation shock momentum index, and that looks at about 100 categories of PCE inflation, and it basically says, are we getting correlated changes but for more than 1 month in some of those categories? And that inflation shock momentum index has actually declined for the last 2 months, April and May. So one can make a case that there's a bit less inflation around than the numbers are talking about, and that some of the momentum may come out of inflation. But ultimately, I look at things like the trim mean. I look at the median inflation. The trim mean is running in the last 3 months, which is, we've talked about that before, 2.7%. The median's running at 3.2%. Services ex shelter and energy services are growing at 4.3%. All these numbers are over considerably over 2%, and they won't be affected by some of these redefinitions because essentially we're talking about the middle of a continuum of price changes. So I'm still worried about inflation, and I think that the Fed is not doing anyone any favor about talking about the kind of redefining down what's happening to inflation. Final thing I'd say about inflation is that Kevin Warsh wants to use more high frequency price data. So there are going to be things like the Bloomberg Price Project and the Billion Prices Project, which State Street recently bought and has a monthly release called Price Stats. People are going to start paying more attention to those high frequency price data and how they differ from what the official statistics are showing. So bottom line is there are a couple of dovish elements to inflation, perhaps, when you look at momentum and you look at these redefinitions. But overall, I think there's still concern that inflation isn't going to come down to 2% unless they tighten monetary policy.
And on the other, part of the Fed's dual mandate, maybe moving over to the labor market, 2 months ago, we saw pretty strong jobs data that pushed rates higher. But then last Thursday, we got a much softer than expected employment report. But Treasury yields barely fell and have now moved higher, though. Has that changed your view at all on the labor market from your more bullish stance the last time we talked a month ago? And what do you think the FOMC is seeing in the employment data that the market and other analysts might be missing?
Yeah, I actually expected a weaker number in the payrolls, private payrolls. Why? Because ADP and Revelio, which are the two other respected sources of data on employment growth, private payrolls growth. Revelio scrapes a lot of job offer data and some other things, and ADP has 25 million payrolls that it directly gets. So it's a very reliable survey. Private payrolls had gone ahead of where those two indicators were. Now they're all showing that after basically flat employment growth last year, employment in the last 3 months has accelerated, or the first 3 months of the year accelerated to about 50,000 a year, and now it's growing at about 100,000, per month. Now it's growing at about 100,000 per month. So, if we're in 100,000 per month jobs gain, and that all three measures are showing that, and we don't have much growth in the labor force, that is suggesting that the labor market is about neutral right now. And when you look at that Kansas City Fed Labor Market Conditions Index, which I've talked about before, it's got 24 measures of employment, not just the number of people employed. That was basically flat in June, and the momentum actually improved slightly. So I think that the Fed's characterization of the labor market as being either neutral or slightly improving wasn't affected by those numbers. And the Beige Book kind of showed that as well, which is essentially all the Fed regions, the companies within those regions reporting on their demand, current and future demand for labor. As to what the Fed's thinking about the labor market, it was very interesting that Kevin Warsh basically said we don't have a cruel choice between lower inflation and unemployment. Ultimately, if you create a low inflation environment, employment will take care of itself. So that one of these task forces on inflation, the only reference to employment in a task force is the one on productivity. So basically, I think the labour market's taking care of itself right now. It would take a significant offloading of employees over the next 6 months or so for one reason or another. I can't think what that reason would be, and a rise in the unemployment rate for the Fed to be uncomfortable about the labour market now. So I think going forward in the next 6 months, it's all about inflation, not necessarily about labour, unless we have these outsized surprise losses in the labour market, which I certainly don't expect.
Um, that leads into maybe back to the Greenspan era, where Alan Greenspan's decision to hold rates steady back in 1996 has been cited frequently as a possible model for Chair Warsh's first year, allowing time to assess whether inflation pressures are contained while avoiding unnecessary restraints for the economy. And every cycle is different. There are only some comparisons, and this was a while back, but how similar do you think, the environment we're in now is to back then in 1996?
Yeah, so we had a recession in the early 90s. Then we started to get into a situation where uh, the economy started to slow down again in 94, 95, only 5 years into the expansion, and the Fed actually cut rates. And, it was quite effective because fairly soon afterwards, we started to get an improvement in employment again. And in 1996, we had improved employment and we had a slight rise in inflation. And some of the models, like the so-called Phillips curve, was suggesting that at that point, particularly with asset markets very strong, which resonates right now as well, that the Fed should tap on the brakes again and start raising rates. He didn't do that. And instead, he had the so-called irrational exuberance speech where he talked about asset markets potentially getting out of control. That irrational exuberance speech didn't do much because we continue to have rises in asset markets right through to the end of the decade. But the idea was that he was a visionary who saw that the impact of technology, globalization, the peace dividend, balancing the budget were actually disinflationary, and that the Fed could allow rates to actually continue to eventually recede without causing inflation. And that turned out to be right. However, we have tech now, but globalization, we're deglobalizing right now. That wasn't the case, under Clinton Gore, we were globalizing and that was disinflationary. We also had a peace dividend and balancing of the budgets back then. We certainly don't have that now. We have a 2 trillion a year budget deficit. So I think that, as you said, every episode is different, and we can't say that, war should do a Greenspan, because the conditions that we had back then don't necessarily hold right now. And the other thing to remember about the 96 hold is that eventually, 3 years later, we had a bigger correction than if the Fed had lent against what was happening in the mid-90s. We had the Russian debt default, we had the Asian crisis that was disinflationary anyway at that time. So I think that a rate hike turned out it would have been a bad idea. But overall, I don't think that the Greenspan example is a particularly good one because we don't have the disinflationary effect of globalization or the balancing of the budget that's happening, that was happening back then and is certainly not happening right now.
Makes a lot of sense. To wrap up here, I want to just hit on the rate outlook. What are your expectations for the path of interest rates over the next, say, 12, 18 months? And where do you see the biggest risks to what's currently embedded in the rate markets in terms of expectations?
Yeah, I've been kind of beating this drum for some time on the upside in rates. And, to some degree, the war kind of helped economists who were hawkish on rates being right. So you can't kind of claim credit for that. But one interesting thing I want to point out is that the range for the 10-year bond this year has only been 75 basis points. If you go back, 20 or 30 years, the annual range between the high print in a year, calendar year, and low print is 150 basis points. Now, most of that range tends to happen in the first half of the year, and then we range trade within that range. So we've got a relatively low range right now in the bond yield, and we are testing the upside. And I still think the balance of likelihood is that if we test this range and go beyond the 75 basis points we've seen in the first half of the year, it is going to be in the upside in rates. We have a strong economy. We have a labor market that overall has tightened. We have inflation coming from sources other than energy at the moment. And we haven't really, I think, fully priced that in. And so I think that, there's always a question about whether the Fed can actually avoid. I think Kevin Warsh would like to be able to avoid hiking in the same way that, Greenspan said that we have this productivity miracle happening and we don't have to tighten rates. But there is a risk of inflation getting out of control. I actually think there's going to be a curve steepener, the 2-year to the 10-year getting wider. So the 2-year may be anchored by the fact that we probably will only have 1 or 2 rate hikes from a Fed that's fairly reluctant through the chair to be hiking rates because they look at productivity and other things. But the 10-year rate, which again is based off the CPI, not the PCE deflator, which is the Fed's target, is less anchored by what the Fed's doing. So yeah, I do continue to think that 6 to 7 years into the economic expansion, the direction of travel in rates is still higher. The conditions under which that wouldn't be the case are, of course, a correction in asset markets, that the persistence of the war, some problems with the pricing of AI-related debt, comes crashing down, and so you get problems in debt markets, private debt and private credit markets, which lead to some contagion, and then you could potentially get into a recession. And the Fed, under those circumstances, would see a disinflationary threat, and then they would move on it. I'm not enough of an expert on that, but I do know from being in CalPERS, it's very hard to define the end of an economic cycle. And when a financial event, which has caused all of the last 4 or 5 recessions, except for the one with the pandemic, when that could potentially turn around. So yeah, I think I continue to think that the direction of travel is up in rates. And certainly we've been in a war economy, or the economy impacted by an oil shock for 3 or 4 months, and the economy has powered through that and isn't showing too many signs of slowing down.
Well, thank you, John. This has been very interesting. Thanks for talking to us. And everyone that's listening, you can go to derivativelogic.com for more resources, such as our weekly newsletter, Straight to Smart or Forward Curves, or any other data you might be interested in. Thanks a lot for joining us.
Thanks, Jennifer.